everybody, it's Chris here from Serene Education with the 4 majors and update for the second week of February. So that'll be the 8th to the 13th of February 2015. Okay, so let's have a look and see how the week ended for the 4 majors. I'm just going to have a quick look and see how non-farm payroll came out. First Friday of every new month, we have non-farm payroll figures. Moving on to the big number of the day, which would be in the non-farm payroll figures, and you'll notice we saw some fantastic figures for January's non-farm payroll at 3,290,000 new jobs created. However, for February they expected a contraction, down from the 329 to 234, so quite a drop in terms of the contraction they were seeing. However, what we saw was a favorable outcome. It was still lower than January's figure, don't get me wrong. However, still far better than the 234,000 that they predicted or forecasted. It actually came out at 257,000. So a good 20,000 jobs positive. So we saw the US dollar rally quite significantly against crosses. Mixed results or mixed feelings with the non-farm payroll figures, primarily because it doesn't really show you the negative sentiment or unemployment that we're starting to see through mostly the oil industry, and you'll probably see it out there. We've seen a lot of negativity or low oil prices, which has had a major impact on a lot of countries' companies who deal in the oil sector growing. But we haven't had those figures out on this particular figure, and I think if we had, it would have been or showed us a different outlook altogether. The unemployment rate for January, you can see, however, that got slightly bigger concern. Only a 0.1% difference from the 5.6. However, still not entirely what we want to see, but in fact, the non-farm payroll figure over here was the one that really took everybody's fancy, and we saw a lot of positive sentiment for the US market for the on the outcome of that data report. So, non-farm payroll, fantastic. What did it do to the charts? So let's move on to the charts. Let's have a look at, as I mentioned, let's look at the 4 majors. Let's look at euro against US dollar, and you can quite clearly see, looking at a weekly time frame now, because we wanted to see the end of last week's candle, and you can see last week's candle what we were presented with. We saw a lot of bias to the upside through the first part of the week. In fact, most of last week we saw a lot of positive pullbacks, and we have seen this in the second consecutive week now where we've seen a pullback after a lot of negativity. We saw a lot of movement to the downside through January. In fact, we saw an 8.4% drop, roughly just over 900 pips in total for the euro against US dollar for January alone, and we've seen a pullback. Moving into the monthly fib level here at the 161.8 level, the 61.8, apologies, clearly consolidating. So ideally, if we are still to look at the indicator box over here on the right edge, you can see quite clearly majority of it's still looking negative. The daily showing a bit of consolidation, i.e. a lot of blue arrows in a negative trend. It's primarily consolidation. We've seen consolidation, but that consolidation has taken place at a major support and resistance level in the shape of a fib level. Okay, here clearly the 61.8 at 11858 has been a target area since the break over here through the last week of December. So the first, second, third, fourth week going into the first month of 2015, we saw aggressive selling on the outcome of quantitative easing starting, as well as that Greek outcome and change in government. However, you can see we've seen a slight pullback over the past couple of weeks. But yesterday's close telling us there was still more selling sentiment on this board. We were quite vigilant because of the fact that we saw more buyers in the market. Okay, that led to this pullback, and that's primarily as we saw further positions being closed and profit being taken. But you'll notice by the end of the actual week, in terms of Friday's announcement, let's move down to the daily. You can see that both we saw Tuesday, Wednesday, Thursday, and Friday a lot of bull, bear, bull, so a lot of indecision through those 4 days of last week. In fact, Monday very flat after the Sunday evening, and then we saw the prior week's resistance level high being breached, but none of that real momentum really taken forward. And you can see the candlestick still very much red, so telling us we'll still be looking for negative sentiment. We do have a blue arrow However, the overall bias for euro against US dollar is still one of negativity, long term and short term. And we've just seen consolidation. Well, that's all we're seeing is consolidation in what is very much a negative trend. So look this week for a continuation. The monthly fib level would be far better if we actually saw price dropping below that level to see any further genuine selling for the remainder of February going into March. Clearly, where price is trading around, or the floor level of where she closed on Friday, which was the support level for Thursday, the support level for Wednesday and Tuesday. So if we can get below that level aggressively, you could potentially look for selling positions towards that monthly fib level, which is a good 100 pips away. A bit more risk on the table because your money management 1-to-1 here, is far less than 1-to-1, to be honest with you. So if we drop down to a 4-hour time frame, you could see that what we have is the close on Friday evening. We have a red arrow, but the candlesticks have been blue. We did see the last candle going into the close on Friday evening turning red. The RMO is below and the OSMO is below. However, we want to see a clear break below the current support level, which was the support level that we saw through most of last week, being breached before we can even contemplate looking towards that monthly fib level below as a potential first target for the coming week. So look to see what happens going into Sunday evening's open and then into the Monday morning open to see if we can actually capture some of that negativity. But we would need to see a nice bearish engulfing candle close lower to actually indicate or to execute any selling or shorting opportunities towards that monthly fib level going forward. On to sterling. Here again, looking at the weekly time frame. Okay, we've seen a slowdown for sterling as well as on the outcome of what we've seen recently. If you look at, we've seen a very, very negative trend on the weekly time frame for sterling since the highs we saw in June of 2014. We've got below the 23.6 level, okay, and we have seen price using this level, the monthly fib level here, as a viable resistance level. We've seen price on a number of occasions over the last month through January in particular, actually using or failing to actually break above this level on the pullback, and we haven't seen any new lows. Okay, I'm just going to draw a horizontal line on the current weekly low, which will be this level over here, which was 2 weeks ago, and that would be the level where we would want price to be trading below, okay, to give us a genuine entry for the continuation towards the next level, which would be this area right down here, which is roughly around the 134.60 and change mark, which is a very strong profit target level. We're looking at potentially in excess of 1400 pips. So hang on, be vigilant. If we don't see sterling making any new highs and we see a continuation, i.e. a break of the current support level that we've seen 2 weeks ago, you'll notice that we have a red arrow. The candlesticks are now red. Both are moving averages are all above price. The RMO is below the zero level. The OSMO has seen a bit of convergence. There we go. As we've headed into this monthly fib level, however, the overall bias is still one of negativity. You can see that the long-term sentiment here, weekly and monthly, is very much negative. The daily, we've seen a bit more positiveness coming into that particular time frame, primarily because we haven't seen any new lows over the past 2 weeks. So failure to make new lows on your daily would constitute for price to move sideways. You can quite clearly see now we're moving to a daily time frame. Look what's happened. Price has been trading within a consolidative range for a number of weeks. We saw the bull breakout on Thursday, and then on the Nonfarm payroll figure outcome, we actually seen price pulling back aggressively, so back below that monthly fib level. So if we are to see the breakout on Thursday being potentially a viable positive outlook, then we would need to see price getting above the 23.6 level here at 152614, and remaining above that level for the remainder of this week going into the third week of February. Failure to do so would then see price, if we were to see price falling aggressively in the direction of long-term trend, which is negative, then we would need to see price moving away from the monthly fib level intraday, and we would need to see a red arrow. What we don't have over here at the moment on the daily is a red arrow. We do have red candles. The RMO is still below the OSMO, which is above, which is a positive, and then we have red candles and the RMO below. So two cancels two, so there's viable no trade. We still know that there's still negative sentiment for this particular pair, so we should be looking to the downside. That would only occur if we see price remaining below the monthly fib level. You can see on the 4-hour time frame now, price is trading at the institution moving average. See a lot of positiveness intraday as we saw prices gaining a bit of sentiment through last week. That, however, is null and void if price still uses the monthly fib level here as a genuine resistance level, and then we could see a continuation with long-term trend, which would mean that we should be looking back towards these lows here that we saw at 14928 and change, and that is where price is trading right now, to that level in excess of 300 odd pips. Okay, so there we go. Here's the lows. That's going to be our target if and when we get viable selling signals with direction, long-term direction, which is negative. Okay, the longer she stays above the high point here, then we start seeing more bias to the upside coming into play, and then we could see sterling rising even further for the remainder weeks of February. Moving on to US dollar Swiss franc, major move we saw through January, in fact, on the Swiss National Bank unpegging its currency with the euro. However, since then we've not seen any new lows. In fact, we've actually seen the last 2 weeks moving higher on US dollar strength and getting above the monthly fib level. In fact, if we look at the overall move of that candle, you'll notice that price is now trading into the 50%, the halfway mark of that bear candle that we saw. Okay, so we took the whole range of that bear candle on the weekly, taken the fib level, drawn a fib level on here. We know where half of that is because that's the 50% line here at 9270 and change. Price is trading at that level, so it's pulled back 50% of that entire negative candle that we saw, which was a good 1900 pips drop. So in order to see US dollar Swiss franc trading higher for the foreseeable weeks remaining for February, then we would want to see price getting above the 50% level here at 9270 and change, and remaining above that to then target the 61.8 at 9499 and change. In between those two levels, we're looking in excess of 220 odd pips. Daily, let's drop down to the daily, see what's happening on the daily. Those strong figures for the US dollar Swiss franc, for the US dollar, non-farm payroll figures. In fact, we've failed to see those really playing out on the intraday time frames. You'll notice that price over the past week or so has consolidated at the 50% level. So there we go. You can see a lot of resistance above here at the 50% level, and if we are to see any further bullish movement for the US dollar Swiss franc, then we need to see price trading or closing higher than the 50% level here, and then we would want to see all our indicators in favor. So that would mean we need to see the arrow. Then we need to see the candlestick complementing the arrow. We would need to see the OSMA above the zero level, and we need to see the RMO above the zero level. Okay, at the moment now, we have the last candle here on the 4-hour time frame has been a red. We would need to see a blue arrow. The OSMA would need to clear the zero level and turn bright green to tell us that bias is back in it, i.e. the MACD is back in favor of trend direction, and the OSMA is already above that, but it's been consolidating as prices move sideways. So clearly you can draw a trend line on that and wait for the trend line to be breached, the histogram to break above that, get a confirmation candle, and then we could target the 61.8, which on our 4-hour time frame brings us the institution moving average to that level. So that would genuinely be a viable target if and when we did get a genuine candlestick break for that continuation to the upside. Last pair of the day is US dollar Japanese yen. Let's have a look at the weekly time frame. Let's just move this candle. There we go. And what we saw is we've seen a lot of indecision over the past couple of weeks, and then the US strength that we saw on non-farm payroll yesterday actually saw the US dollar rally during the close of the US session. So what we're seeing is the overall candlesticks for the weekly, and the bias overall is strength against a weak yen, and we've seen consolidation over the past couple months. In fact, since November, we've failed to see the US dollar making new highs. However, she's failed to really fall with a lot of sentiment to the downside. And in fact, we took the consolidation that we saw through most of the start of 2014 to the current high. You'll see that the 23.6 level, let me just change the color of that just to show you. There we go. You'll see that the 23.6 level here at 116 has been a major support level for price. And as long as you maintain above that level, then there's always likely for price to reattempt the monthly fib level here at 61.8. and then viable, move back up towards those November highs that we saw here at 12176. So as it stands at the moment now, we've seen a lot of indecision over the past couple of weeks. The close of last week's candle for the US dollar against the Japanese yen has been a bullish engulfing the last 3 weeks of negative sentiment. Therefore, we should be looking for price to move higher. There we go, moving down to the daily. You can see Friday's close, blue arrow, blue candle, RMO above, and the OSMO above. So now, ideally, if you want to, you could either be super aggressive with the entries and then target the monthly fib level here at 61.8 at 119 and change as your first target, or you could be super passive and then wait for the price to break above the monthly fib level and then target aggressively the prior or the November higher before we saw the evening star formation, and that is in excess of 178. You're not going to get all of it, but there's more than enough on the table for you to see a valid return on time invested. Okay, so 2 aggressive opportunities. Aggressive one here, see how Monday opens. You'll notice that we are now trading above a resistance level high that we saw in January of 2015. As long as you can maintain above those levels, we could see a slight pullback through the Sunday evening open, and then as we head into the new week, Monday, Tuesday, we could see continuation towards the 61.8. And then ideally getting above the 61.8 would then constitute, we should be looking for bias long term, i.e. through February, March, up towards those levels that we saw in December of last year as our next potential target here at 12176 and change. Okay, so that's it for the news announcement analysis for the 4 majors. Please be vigilant. There's a lot of data out this week, and that data would have an adverse effect on any currency pairs that you're trading. So if you are looking to trade, please be vigilant. Please look at the fundamental data, guys. Very, very important. Okay, and then you just back it up with sound money management rules. Very, very important. Great templates. You could have a fantastic strategy. However, you've got to back it up with strong money management rules, guys. Okay, I'm going to leave you with that. Hope you have a fantastic week and keep it as simple as possible. Until then, you guys trade serenely.